9 a.m. We'll be kicking off just a bit early here on August 4th. Happy Monday to you. Hope everyone had an enjoyable weekend. Well, all things considered, obviously. I know in chatting with Jeff here just a minute ago, he has a longer set of slides. So I'm not gonna rush through my end of the presentation, but we may run a little longer today than we normally do, especially as Jeff noted, it is the beginning of the month, first trading week of the month. Big data week last week, and so a lot to cover with you. A reminder, we're extending the deadline for the Millionaires Trading Club. I made a mistake and had two deadlines running concurrently. Since this event doesn't take place until October, I'm going to extend this. I'll get more details out later this week. For those of you coming to Vegas or interested in coming to Vegas, we're down to 20 seats remaining. So we have a pretty big crowd already booked in, about 40 people. So it should be a good time and a heck of a bar bill. So looking forward to seeing those of you who will be in Las Vegas with us in October. Later this week, or next week, next week, I will be announcing something new that we are bringing to the live trading component during the Millionaires Trading Club event, which I think Dave and I have talked about this, and we think it will be both instructive and it will help you to make better decisions in your trading. So I'll detail that next week, and we'll get more details on the deadline and et cetera. So still a $200 discount, whether you attend virtually or live, just a little public service announcement. Notes for Monday for today, futures moderately higher, a little bit of a recovery from the job scare last Friday, which Jeff will talk about in detail here in a minute. I will stress that if you go back to one of our early June Breakfast Club sessions, we talked at length about the revisions and how they were occurring throughout the first quarter, and to revisions to jobs numbers, how significant they were, and that no one was paying attention to them. I think they're paying attention to them now. So Jeff will cover that a little bit in detail. More tariff details released on Friday, higher in some cases than expected by Wall Street. So the weekend sort of absorbing that detail. A little bit of a bounce back in futures this morning across the board. I'm going to tell you right up front, I think that the Trump people are going to be surprised that firing the head of the BLS is going to turn out to be a mistake. Because it creates the potential, just the potential, for a lack of trust in the numbers. And the BLS does not just do the jobs report. They also do the PCE report, which is a key inflation and consumption report. They do the GDP report. So this, whatever you want to call it, I think this is going to prove to be an error in judgment on their part, because in part, the claim that it was politically motivated. What the media won't remember is that last year, at about this same time, there was a massive jobs revision that took place pre-election. So this is a common occurrence. It is simply the fact that these numbers, they don't fit the narrative of this great growing American economy. But the thing is, it's okay. And in part, it's because right now you have a messaging problem, and that really revolves around the Federal Reserve cutting interest rates. You don't cut interest rates when the economy is strong and growing. You cut it when the economy is weakening, when demand is declining. And we have these competing messages, which leaves you as a trader, as an investor, asking, well, which is it? Is the economy weak or weakening, or is it strong and growing? The Fed has made the right choices right now, waiting to see what happens. I'm not a fan of the Fed's actions. I've told you before, I thought they were late cutting rates last year. They were certainly late raising rates during the inflation-driven pandemic period. So the Fed makes mistakes. But as it stands right now, we're in this in-between area. And Jeff will do more on the jobs front, but weekly jobless claims have still been at historically low levels. So that means fewer people losing jobs. So there's not a massive hole in the economy on the labor front. The fact that there were still positive job additions in the May, June, and July period, means that jobs were still being added, not at a huge clip, not at a great pace. And we'll have to wait until September to see what revisions get made to the July jobs numbers, which were 73,000 and well below what was expected in the roughly 140s. So, this is not necessarily the most important number. The most important number to me is on Tuesday, and that is the ISM Services report, the ISM Services PMI, Purchasing Managers Index, because the economy is 60 to 65% services driven. The manufacturing report last week came out a little weaker than expected. But that services PMI has to stay above 50. If it falls below 50, that would be 2 of the last 3 months where the services PMI was below 50. Most services are not affected by tariffs, not all, but most. So you should see less impact on the tariff front in the services PMI. And so that makes that report the big thing for the week, and that's tomorrow, what, 8:30, or I think it's at 8:30. So anyway, that's the key thing to watch. But this everyone needs, I think everyone in the media, Wall Street, etc., need to take a step back following the jobs revisions report. Let the economy settle out. It'll take care of itself. I don't see recession right now, because no other metric points that direction. So until that's the case, and Treasury yields didn't collapse, which would have been more recessionary, none of that happened. So a single massive revision, massive though it was, wasn't the end of the world. So that being said, last week we shared with you this look at a capital and income chart, and table chart, for which was related to the event we held last October for Millionaires Trading Club. And I went back this weekend and started building these for both Income Masters and Millionaires Trading Club. So I want to walk through some of the changes in what we've done, or what we're tracking, or how we're tracking. So that'll be the weekly income report for this week. Let's take a look at the combined report. The two things to note here for Income Masters: last week I didn't give you a report. I just focused on Millionaires Trading Club. So this week I'm adding back in the Income Masters section the week ending July 25th. So this right here is just for last week. A little bit of a quieter week. 8 trades closed through both services. Net income $1,700, 18,000 in capital, 9.4% overall return for the week between Income Masters and Millionaires Trading Club. On the master side, as I said, I was dropping out these equity curve capital efficiency charts. So I have those. In the weeks ahead, I'll be bringing you a new format that can include the long-term positions along with the short-term trading results, and also take a deeper dive on stocks that we've been trading along the perpetual income side. For those of you in Income Masters, I did see the assignment notes on Blackstone. I think it's the 155 call. So I will pass that along to Dave. I'm sure he's aware of it, but I'll pass that along to Dave to make sure that he is aware that some of you had assignment on that Blackstone position, and that he can address it during today's Income Masters session, if not earlier in the day, depending on what action he believes needs to be taken. So just so everybody is aware, we did see that, and we will pass that along to Dave for assessment. So this is an example of what these charts will look like. I've broken out June and July separately, just in a notes format, and then I'll put them together in the capital and income report. But the way that I'm tracking this right now, just for simplicity, is trades that were opened beginning in June, from the time that we made the switch to the daily format. And I did the same thing with Millionaires Trading Club. So I'm not including anything right now that took place prior to June 1st, because it would have taken me way too long. I'll come back and deal with those at a later point in time. But for the month of June, we reached a max capital on those new positions of just over 36,000. Total income for the month was 2493. Just from those June trades only. We had other trades that contributed positively or negatively in Income Masters, but I'm just focusing on the June trades only right now. Average capital per day that was allocated was about $25,000 during this. This was the ramp up period to the new daily program, and the return on capital just under 10%. And then in July, I get a bit of a wider view here. By the end of the month, we actually decreased capital exposure by about 17%. We started the month at that max capital level of just over 36,000 and ended it at just over 30,000. Our income from the June and July trades period was $4,511. Average capital ticked a little higher, 28,000, and an overall return on capital, on average capital, excuse me, for the month of just over almost 16%. So when I put them together, it looks like this. And if you've heard me reference the caterpillar effect, where we've been opening and closing trades, you can sort of see right here's the caterpillar effect. Opening, closing a bunch of trades, opening new, right? That this is common in periods where we have not necessarily volatility, but we may have longer dated positions or a longer time to reach good till cancels. So what this chart shows me is when I'm reaching a high level of capital or a higher level capital, and it can tell me when I may not want to put on new trades. So although we're not tracking all positions in Income Masters at the moment in this chart, if we were to think ahead and say, well, I know that if my portfolio is 100,000, I'm currently sitting at about 30% capitalized. I want to stay somewhere around 50% capitalized. That means that you still have about 20,000 in capital that can be allocated. And at the same time, we're tracking the trends in the income. So you can see the income has been rising over the 2-month period. That's a good thing. Eventually, when we have a trade that loses money, whatever, we'll see the changes in the equity curve over time. But in the short term, this is a starting point that I wanted to get underway and then continue to build on and build out. But one of the things that and this was true in in Millionaires Trading Club, one of the things that I noticed, you can see we've been sitting in this range of $25,000 to $35,000 in capital allocated. And as we got closer to the end of July, it was Dave's hope and intention that we would be able to sort of reduce our capital exposure a little bit because we didn't know what would happen with the August 1st tariffs. And now we have some more information and we can make better decisions about how to allocate capital in the weeks ahead. So that being said, for the period ending August 1st, this is a 2-week catch up. We had 10 trades closed between July 21 and August 1st. Average days in trade 12.6. Total capital in that period 23,000. Net income just over 2,300, or a 10% return on capital. So the bulk of that net income was actually in the July 25th week, where we had over $1,500, and then another $900, $800 last week, another $800 last week, 765, I think, if I have to be exact. So net income month by month, July was a banner month. We had a very good month in July for the beginning of the third quarter. Obviously, we begin August now, and we will see how August transpires. But overall, year to date, a little over $25,000 in income for Income Masters. Moving on to Millionaires Trading Club, a quieter week as we expected. With the Federal Reserve meeting, with earnings reports, big data week. Sub trades were challenged in Friday's reversal, so you should expect some continued work on those. But keep in mind that the bulk of positions right now that are still open, most of those have August 15th expirations, so we have plenty of time for the market to correct itself. We did close 4 trades last week, half of them bear call spreads. half of them bull put spreads. So we sort of split the market and traded from a neutral perspective. For the month of July, 42 total trades open. That's about 10 per week. Keep in mind that many of those trades that were open were closed within 1 or 2 days, like the Russell trades, excuse me, which were running an average day in trade of just about 2. So 33 trades closed. Out of those 42, that was 100% win rate, and 9 of those trades have carried over into August. And then we opened additional trades on August 1st. For the week last week, those 4 trades, average time in trade 2.75 days, so rapid. Total capital $8,700, net income $953, a total return on capital of 10.9% for the week. And the capital performance, again, this is starting with the July 7th kickoff of the new daily approach. Again, you can see that this is step 1 was the ramp up in capital. But here too, one of the key things that I had mentioned last week was Dave was struggling to get more capital in play, in part because we kept having a bunch of trades close here, certainly a whole group of trades closing here. So it wasn't not that it's a problem. It was just you could see that we were stuck in a range here between 15 and 20,000 for most of the month, and then finally at the end of late last week, we were able to get a little bit more capital allocated. We'll see how those trades work out in the forward weeks. So for the month, oh, that's a typo. I'm going to go back a slide. Hang on a second. This should be 63.23. Somehow I carried over, this is not correct. I carried over the wrong number from Income Masters, putting text on the chart. My mistake here. Correct number should be 63.23 on that one, which would then match up with this 63.23. But you can see we've doubled our income and Income Masters here just in the month of July. So 12,731 for the year. So overall, Income Masters and Millionaires Trading Club doing exceptionally well. I mean, at this pace, we will catch up to Income Masters by October, and then we'll have the October event, and hopefully we'll blow past the Income Masters numbers. So with that, that wraps up the weekly income report. Jeff, let me stop sharing and turn things over to you.
All right. Hello, everybody. Just give me one quick second to find the slideshow, and we'll get started. In the meantime, grab your cup of coffee, get ready. Oops. Oh, this is going to be a problem. Hang on one second.
So while Jeff is once again struggling with his slides.
Not the slide. I changed my display settings on multiple display, whatever. It doesn't matter. Go ahead.
So yes, Joe, I will. It's to be blunt, it's time consuming in the initial stages. So when I go back to build this out, the capital and income tracking charts, I will add in controls for single contract values so that it's not solely based on Dave's trading. That's a great suggestion, and I'm happy to take that up and add that in. Thank you. All right, Jeff.
All right, I'm working. I'm cooking. Hang on. From the beginning. You know what it's doing is it's not giving me, which is fine. I'm gonna wing it because we don't want to waste time. It's not giving me my presenter view, but that's okay. Oh, this is fascinating. Oh, come on. Share screen. Share. Why does this always happen? That's 2 seconds. 2 more seconds. I'm gonna get this. I swear. All right, PowerPoint. Here we go. Now you should see
There
slides.
you go.
Do you see slides?
Yes.
Good. Okay, now I just need to get back to where I see what you're seeing. Okay. Oh my gosh, that was fun. Okay, so just overnight futures are pointing higher, as John mentioned. I just wanted to show this. This is as a little bit more of a conservative trader. To me, this is a do nothing day. We had a big red bar day on Friday. Obviously, we'll get into all of that in a moment. Futures are pointing higher. That's this green bar. So we could see another day or 2 days of going up. So similar to the falling three method, if you will. Although, I wouldn't really say falling three because we've had a lot of, we haven't really had the previous fall. That was just kind of a 1 day thing. But anyway, we could have this, stair stepping sort of rise up and then another big red candle down. So that's what I kind of drew out here is we could easily see a day or 2 or even 3 days higher, and then another surprise day in the future. So for me, I'm looking at the body of the big red candle that we had on Friday. And I'm looking really for the market to decide where it's going to go. So one big red day does not make a trend. So I'm looking to see if we can break higher or break lower and then kind of go from there. So for today, it's more of a yellow flag, cautious day, because we could easily see a couple of green bars and then another big red bar, or you get rid of the red bar and then maybe we just keep going higher, and this is just sort of a 1 day anomaly event. So why was everybody so all up in arms about Friday's job report? Well, John mentioned this already, that people are a little bit concerned that Trump alleged that figures were manipulated for political reasons. If you start taking away the honesty of the Bureau of Labor Statistics, then that starts kind of putting a wrench into a bunch of other things. The other thing that the market doesn't really like too much is when you say that you're going to fire someone, whether, partial, impartial, whatever, and say, well, I'm just going to place somebody in there who knows how to do their job better and who will give me the numbers that I like. Well, it's not about giving numbers that you like. It's about giving the numbers, right? Anyway, so the big deal, though, is that the consensus numbers were about 110,000. Turns out that the actual were 73,000. Private payrolls, 100,000. Turned out that was 83,000, even though unemployment stayed the same. So it was just sort of a bigger shock to the system. And then what we also have is, this is the concern about, the BLS revises job numbers as it routinely does. But if you start saying that those numbers are wrong and you don't have any sort of proof for that the person that was in charge was doing it for political reasons or anything else, you just start saying things, well, that sort of destroys the trust in the American institution or government statistics, which I think, I think there's been a lot of destroying trust in government over the last 8 years or so. But anyway, what it does show is that 258,000 fewer jobs were created in May and June than previously estimated. So that's kind of that big shocker number that people or Wall Street maybe wasn't quite ready for. And then, it's pretty consistent with what we've seen, that economic growth has been slowing in the first half of the year, despite everything that we've said, one big beautiful bill and everything else. Now, I will say, you can't have a one big beautiful bill and then expect job growth in a month. You can't expect tariffs to happen and then have job growth in a month. Companies take months, if not years, to build factories and get their supply chains and everything set up. So while I don't like that, we're calling out government officials with no evidence, you also have to be a little bit patient. If you are on the Trump administration side, you have to be a little bit patient. And just because there's slower job growth doesn't mean that what you're doing is wrong or bad. Again, trying not to be political here, I'm just saying, that it is going to take time. So it wouldn't be surprising to see a slight slowdown before some of these things take place.
But
So
we have to keep in mind that the although the jobs additions were largely in the healthcare sector, they were still positive. So we have not had a negative jobs report to date. Even if the July jobs report is revised lower in September, again, we're looking at a weakening in the hiring side, but we've been talking about no hire, no fire for 6 months. So a slowdown on the hiring of labor, it's not a surprise, not at least not a surprise to us. But I think until we see other metrics like Tuesday's PMI, until we see other metrics telling us that there's truly a slowdown taking place, we want to be cautious about pegging one data point as like the trigger for something, when it's just a number right now, right? That's all. It's a number and a trend, but under underlying metrics, for most of the economy are still stable.
yeah, I was going to say the funny thing is, remember just last week or even 2 weeks ago when earnings season started, we saw all these companies just destroying earnings. Part of it was because they revised lower in first quarter, but either way, like just a week ago, markets shooting higher, all-time highs. Everyone's, earnings coming out saying people are spending money, everything is great, economy is great. So just because one jobs number comes out, now everything is bad. So this is where the news kind of gets, can get in your way, especially if you're trading versus investing. Your day-to-day trading can get a little confusing, which is why ultimately I don't focus too much on the news. I just try to come up with strong stocks moving in one way or another, and then figure that out. I don't really have a theme to my trades all the time. But the theme of the week, certainly for me, is just yellow flag. We're just being a little cautious on some of these things until some of it sort of nets out one way or another. So now what we have, and so speaking of sort of this weird dichotomy of things, jobs down, but tariff revenue is up. We have 29.6 billion coming in from tariff revenues per month, and that's estimated to shoot higher. But the big question that we all have as we're kind of going through all of this is we say, yeah, this is great. Tariff revenue is up. If all else stays equal, then we're going to see all of this revenue coming into the United States. But that's if everything else stays equal. So the question is, will Americans stop spending money? Will Americans, as prices increase, it doesn't matter who is paying for the tariffs, it ultimately comes down to who is buying goods. So if good prices, if the prices of goods continues to rise and people stop spending money, then that's obviously going to affect the stock market. So despite whatever revenue comes in from tariffs, and then if people stop spending goods, then the revenue from tariffs ultimately comes down as well. So we're just kind of seeing, we're in this wait and see. But yes, the data right now looks good with revenues from tariffs skyrocketing to higher levels that they haven't seen in decades. But the question is, will something else crack in the meantime, or will that stabilize and everything continues in sort of a good way? We don't know. The other thing that we don't know is that the estimates are still showing that despite the latest data that we have from tariffs, that the increased tariff revenue is still not enough to counteract the tax cuts from the big beautiful bill over the next decade. So it would take tariffs plus job growth to basically flatten out or be even with the tax cuts from the big beautiful bill. That's at least according to early on estimates. So we'll see how that all plays out. But that's where some of the data gets a little confusing. It seems positive, but then everyone's reacting so negatively to this jobs report. And as John just said, it's revisions down, but we're still, it's moderating if anything. So
And if all this stuff is worrying people,
let's not all lose hope here.
if all this stuff is worrying people, one of the things that we should do, we can do this in next week's Breakfast Club, and you may be able to do this in some of your trading in Millionaires Trading Club, Jeff, is hedge to the
Yep.
downside, right?
Yep. Well, I'm going to talk about that in just a second. You just
Oh, you
wait.
just reading my mind. Go for
Yes.
it.
All right. So this is actually a slide I just added while John was talking. So John mentioned, you cut rates when the economy is slowing, which is true. So actually, it's not necessarily a bad thing to see job growth slowing down. It's not necessarily something that we want to run to and say, oh, we need to fire everybody because the numbers aren't what I want them to be. In fact, the numbers could be really what you want them to be, because
Exactly.
if we
That's
start slowing down, that's when we stimulate growth. So not surprising to see the Fed watch is now up to 85.5%, saying that there would be a rate cut in September that would help stimulate growth. That's what we want to see. So again, let's not everyone freak out about a Friday jobs report. There's other things which I'll get to that you might want to be cautious about, but again, theme of the week, little cautious. All right, so we also have earnings. So over 100 different companies reporting on earnings. So this is going to be, I don't care what the jobs report is. I'm tired of talking about the jobs report. What I'm really interested in is earnings from some of the different companies, because these companies are so diverse. We have a little bit of everything. So we have ANET, Airbnb, AMD, Palantir, Disney, McDonald's, Uber, Cat, Pfizer. These are just some of the over 100. So networking, equipment demand, enterprise software, government contracts, that's Palantir. Germany just said that they were putting more into their government contracts with Palantir over camera software. So consumer spending habits, we have Disney, we have McDonald's, Uber Eats. Are people, cutting back on spending a little bit more on Uber Eats? So ride sharing, food delivery, industrial activity. So that's what we all want to see with big, beautiful bill and everything else, is how is Cat doing? What is Caterpillar proposing for the future? And then we have a little bit of healthcare with Pfizer. So I think this is going to be more of an important story than the jobs report on Friday. All right, and as John mentioned, I'm not going to go over this too much because I think he already did a really good job with this. It's a little bit slower of a week. It's a very important week, but a little bit slower, certainly compared to last week when every single day we had something. Of the major reports, there's minor reports out there, but of the major reports, these are the two that you need to watch out for, especially if you are trading zero DTEs or anything like that. All right, so sector rotation, this is what it looked like last week. Kind of funny. Not funny. It's everything was green. We had the majority of the sectors trading above their 5-day moving average, a majority of sectors trading above their 20-day moving average. And I foolishly said, S&P has room to go higher, financials has room to go higher, industrials has room to go higher, although getting near that 80%, but still had room to go. I thought utilities, a little bit overbought at that point. Thought consumer discretionary was getting to be a little cautious on that one. So everything seemed, last Monday, it seemed like we were gonna keep moving higher. Well, this is what the last 5 days ended up turning out to be. And it looked like utilities was actually the big winner. Stuck at 90% of stocks in utilities trading above their 20-day moving average. The rest of the sectors did not have the best week ever. But if you see, actually some of these, materials was not just a 1-day move. That was kind of a weekly thing. There were some like consumer discretionary where the majority of the 5-day lower move all happened on Friday. So, take some of that with a grain of salt, but it was kind of a weaker overall week, even though it started off, seemed like it was going to start off strong. And I'll get into chart patterns in just a second. So this is what we have this week. Last week everything was green really in these first two columns. Now everything is red. So the same is also true on the downside. Anything below 20% tends to be oversold. So the good news, if you're looking for good news in all of this, even though hope is not a plan, but what we're looking at is the majority of these have already sank to oversold levels. We were maybe a little frothy at the top, and then 5 days later, now many of these are in this oversold level. So it wouldn't surprise me if we did see a 1 or 2 day bump higher over the next couple of days, just because some of these just got really, really hit hard last week. And then there's utilities. The only one still with all green in all categories. I still think, utilities at 90%. It doesn't mean that it can't stay there for a while. I just would be a little bit more cautious on utilities, or certainly you have to be in those strongest of the strong stocks within utilities if you want to keep that going this week. So this is what it looks like. One of the things I do is I look at the, that should be EUSA. Well, it is EUSA right there, but that is the United States Equal Weighted ETF. Oh, there it says EUSA right up there. So this is one of the things we talked about last week, and it was like, hey, 5 days ago, it looked like we were finally breaking out of this range. And then what I was looking for is, even if it did retrace, I was looking for it to find support at this previous high. Well, it fell through that support, and then even at this low, it kind of fell through support there as well. The good news, I guess, if there's any good news in this, is we did have a longer, lower wick on Friday. So at one point, the EUSA all the way down to 98.22, it did kind of find its footing in the afternoon trading up to 99.08. So there was at least some of the lows were being bought, which can potentially be a good sign. But it just shows just how widespread the selling was on Friday.
Can you draw your line back? Go back one slide for one.
Sure.
Hold on.
Yeah. We are still above the 200-day moving
That
average.
low is pretty much matching the resistance point at May 16.
Yeah, back here. Yep. So it's it's not necessarily a bad thing to stop right here. I was just hoping that we weren't going to go down there to stop. I was hoping we were going to kind of hit somewhere in this area and then bounce higher. But yeah, it's not a complete breakdown yet by any means. And on the smaller time frames, what I do like about what I'm seeing in the EUSA, certainly if there is any sort of rebound this morning, is this dropped down pretty heavily through 10 o'clock, right as all the news was kind of being deciphered and ingested and all the rest. And then really in the afternoon, for most of the afternoon, we had a move higher. It's not exactly the strongest move higher, I get it, but it was different than what we saw all week. And so this is last Monday when we were talking, was this day here. And you noticed it opened, moved lower. Tuesday opened, pretty much moved lower all day. Wednesday, we tried to move higher and just said, nope, we're moving lower all week. Thursday, again, tried to move higher in the morning, said, nope, we're selling off in the afternoon. And so Friday is finally that sort of different trend that we actually had last Friday too, where we open lower and then move higher throughout the day. So that's what I liked about Friday's sort of price action, is that the whole rest of the week, we could never really finish on a strong note. But yet Friday we did. So hopefully, it's not like last Friday where it starts off another bearish week. But that's what I liked about Fridays is we went down to that low, we kissed the low, and then we started rebounding from there. So one of the things I like to do with the EUSA is if I'm going to take an overall bullish stance on the market, and there's always a bullish market somewhere, whether, if sector rotation really happens, we can always get bullish into some of the defensive sectors. But overall, if I'm trying to follow the overall trend of the market, then one of the things I like to do is when the USA is trading higher than it was 5 days ago, then that little cell turns green. So right now, as of 8/1, it was trading at 99.08. 5 days ago would be about 102.26. So again, that's why this is the whole theme of the week is just caution. I don't want to go really too bullish in the market, in the overall market, unless I'm seeing that the EUSA is trading higher than it was about 5 days ago. And again, that continues. So, so it needs to trade above 102.26 today for me to go really bullish. It needs to, if it doesn't do that, then tomorrow it needs to be above 101.80. If it doesn't do that, 101.72. So the nice thing is this is actually getting lower because all of last week, trending lower. So it, even if the EUSA kind of remains flat this week, then by the end of the week, it only has to be above 119 cents for me to, start thinking we're a little bit more on the bullish side. So that's just one way that you can look at market breadth, market direction, and determine how bullish or bearish you want to be for the week. All right, so because it is the first major trading week of the month, I want to look at some seasonal data, give you guys as much information as you can to be successful traders throughout the month. So if we look at July, so this column here is July. Average for July is a 2.96% gain. So it was nice to see all the services kind of matched or beat that, but certainly matched performance. There was an 87.5% positive trading positive since 2010. So that's over 15 years. So July, usually a very bullish month. Again, fitting in with the theme of the week of being a little bit cautious is in August and September, those tend to be the weakest of the 2 months out of the year. I don't know why everyone says sell in May, go away, because you would miss July. You'd actually miss a positive May and June. But anyway, it's more like sell in July and go away until October. But I will say, now this is the hard part with seasonal data, is you sit there and say, okay, well, it's a 50-50 chance. Overall, the average may be on the slightly bearish side, but there's a 50-50 chance in the last 15 years that it's going to be a positive month or a bearish month. So there's nothing really statistically interesting to me when you have a 50-50 chance. You can see even in 2024, despite the red numbers down here, 2024, August and September were both bullish months, and October was the bearish month. So it's more just, it's important to know, but this isn't going to drive any decisions.
It's a neutral month.
Yeah. IWM, this is a little bit more statistically interesting to me over 15 years. 62% of them have traded negative, a little bit higher of a negative average down for August. So it's just something to be a little bit more cautious about. We haven't had a bullish month of August in the IWM since 2021. So we'll just kind of take a look at that one a little bit closely, especially as we trade the rut in some of the services. So what does go up then? You're sitting there talking about all the stuff that goes down. What does go up? Well, communication sector does go up. Again, not statistically relevant with a 50-50 chance. A little bit better than it's at least more than a zero for an average. The median increase, again, slightly better than zero. So not much of a statistical edge there, but compared to all of the other sectors, this at least is showing green. Not all the other sectors, most of the sectors. The other one, utilities, oddly enough, since we just talked about that, a little bit better than 50-50 with 62% of the last few years trading higher. But again, look at the average, essentially nothing. Median's a little bit higher. And the reason the median is higher and the average is almost zero is if the utilities does have a bad month, it tends to be slobber knocker months. Like it is really nasty months, down 6%, down 5%. Almost down 5%, down 4%. So If utilities are going to have a bad month, they tend to have really bad months. So that is something to also be cautious with when 90% of the stocks are already trading above the 20-day moving average. If you're an institutional investor, where are you going to get your return from that when everything has already made that move? So if everything in utilities has already made that move, what are you likely to do? Sell, take your profits, get out of those positions. And then we could have a pretty nasty fall in utilities. And then real estate, actually, again, 50-50, slightly above zero on averages. So it's one of those very, very cautious months. Not financial advisor. So it's just what you want to do, on how you adjust position size, where you put in stop losses, if you're using stop losses, if you're not, just maybe how many trades, or what stocks you're in. Again, this is maybe a little bit less of a time to go all in on the overall market. And then you just spend the time looking for specific trades or specific tickers that you really like. And again, that's a little bit more investing versus trading. Trading, there's always some ticker that's going to go up every day. So, but in investing, you might want to be a little bit more cautious, or maybe look into doing some of those hedges. So speaking of, I always like to give free trade ideas on Mondays. So this was on T-Mobile. I looked at this last night. If it holds on to its 20-day simple moving average, which is right around that 235 level, it's trading at 237-ish, 237.40. So if it holds 235, then you could simply do a 15 August 235 by 240. It was going for 265 in overnight trading, or last night trading, or pre-market, whatever. So it's a 5-wide spread. So you have the potential to make 235. It's about 88% return on investment, as long as T-Mobile holds above the 235 and then rises up to 240. Would not take that much time. And remember, in the seasonal chart, communication services is one of those sectors that does tend to perform better in August. The other thing, if you're a little bit more bullish on T-Mobile, you could go out of the money to the 237.50 by 240. That's 2.5 wide. So that means your potential max profit is $2.50. That's only going for $1.20. So that gives you an opportunity to double your money on that one. And then Harmony Gold is a little bit maybe a little bit of a hedge play. With the big move on Friday, we did see a 10 period cross above the 30 period, and both 10 and 30 period moving averages are above the 200-day moving average. So a little bit of a bullish crossover on gold, or a company that's involved in gold. So going out to September, that $15 call, 75 cents. Very easy to turn that 75 cents into something much more, as long as Harmony Gold continues to move higher. So that is it. It was longer than normal, but that is all I have. That's on the long side of things. If you want to see how Dave and I are going to do credit spreads or things like that, you're just going to have to go see the MTC session today at 11 o'clock.
All right, so that'll be Millionaires Trading Club at 11 o'clock for those of you who are trading with Dave and Jeff. Excuse me. And Dave will be back at 12:30 Eastern with Income Masters live trading. That takes us out of the Breakfast Club for today. Sorry for the longer session. As we said, Jeff wanted to share a bit more data and assessment, as it is the front of the month. We'll be back on Wednesday morning at 8:30 a.m. The recording here should be up somewhere in the next 10 minutes or so. So if you missed any of the first part of today's Breakfast Club, you'll be able to watch that here in just a little bit. Other than that, we'll see you in your live trading sessions, or again on Wednesday morning. Thanks for joining us. I'm John Hutchinson, along with Jeff Wood of Traders Reserve. Hope you all have a great week and a great day. Enjoy your Monday. Thanks.